Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Precigen Inc. Annual Report. Precigen Inc. is a biopharmaceutical company that specializes in developing gene and cell therapies using precision technology. The company operates through two segments, biopharmaceuticals and exemplar. Its therapeutic platforms include the adenovirus platform, which utilizes adenovectors for gene delivery of therapeutic effectors, immunomodulators, and vaccine antigens. The company's UltraCAR-T platform provides chimeric antigen receptor T-cell therapies for cancer patients. This platform is being used to develop several programs, including PRGN-3005, PRGN-3006, and PRGN-3007, which are in various stages of clinical trials for the treatment of different types of cancers. In addition to its UltraCAR-T platform, Precigen is also developing programs based on its adenovirus immunotherapy platform. This includes PRGN-2009, PRGN-2012, and A19, which are being tested for their efficacy in treating various diseases such as HPV plus solid tumors, recurrent respiratory papillomatosis, and type 1 diabetes mellitus. Precigen also provides a proprietary electroporation device called UltraPorator, which is used to enhance the delivery of therapeutic agents. Furthermore, the company offers research models and services for healthcare research applications. Overall, Precigen's diverse range of products and services makes it a significant player in the biopharmaceutical industry. Precigen Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. Precigen Inc. trades at a higher price-to-book ratio of 26.27 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 73% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This also raised the question if that management is diluting shareholders to sustain the business. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. If the business does not improve its revenue and generate positive cash flow, the company will continue to struggle to cover its cost and interest expenses. This combination makes the investment case highly unfavorable unless earning issue is addressed. On top of the cash-burning business, shareholders are consistently diluted. I may be wrong, but I would suggest to stay away from such investment for now. The primary drivers of revenue growth or decline at Precigen Inc. are multifaceted. One key factor is the FDA approval and commercial launch of Papzimeos in August 2025, which had a significant impact on the company's revenue. This milestone marked a major turning point for Precigen, as it transitioned from a development stage to a commercial stage biopharmaceutical company. The realignment of operating segments in the first quarter of 2025 also affected the company's revenue. This change likely resulted in changes to how the company reports and accounts for its revenues, which can impact financial performance. Additionally, Precigen's shift from a development stage to a commercial stage biopharmaceutical company has impacted its revenue growth. These factors have contributed to fluctuations in Precigen's revenue over the past few years. The company's ability to manage these changes and adapt to new market conditions will be crucial for sustaining long-term revenue growth. The net income of the company decreased from $53.1 million in 2024 to $41.3 million in 2025 due to several factors. One major reason was the potential commercialization expenses, uncertainty related to insurance coverage and reimbursement. Additionally, the threat of tariffs on pharmaceuticals, increased operational costs, and compliance risks also contributed to the decline in net income. The profit margins of the company were likely impacted by government regulations and legislation affecting the pharmaceutical industry. The company expected to incur losses and negative cash flows for the foreseeable future due to various factors such as competition for sales force recruitment, variable reimbursement rates, and changing regulatory requirements. Furthermore, the most favored nation, pricing policy, state budget pressures, and Medicaid expenses also posed a threat to profit margins. The changes in net income and profit margins can be attributed to external factors such as government regulations, commercialization expenses, and potential tariffs on pharmaceuticals. These factors have created uncertainty and increased costs for the company, leading to a decline in net income and profit margins. The company's financial performance indicates a consistent trend of generating positive operating cash flow. The data from the past 2 years, specifically in 2025 and 2024, shows that the company has been able to produce significant amounts of cash from its core operations. In 2025, the company generated $2.7 million in operating cash flow, while in 2024, it was even higher at $3.4 million. This positive trend suggests that the company's business model is generating sufficient cash to support its growth and operations, indicating a strong financial foundation. The company's debt level has undergone significant changes over the past year. Initially, there was no mention of a significant increase or decrease in debt level on page 77. However, by page 94, it is clear that long-term debt has increased significantly from $0 on December 31, 2024, to $100,000 on December 31, 2025. Furthermore, the debt level decreased from $100.4 million to $97.9 million, as mentioned on page 82. In terms of interest expenses, there is evidence that they have also increased significantly in 2025 compared to previous years. On page 80, it was implied that cash interest payable on long-term debt has increased by $29,985,000. Additionally, the new loan agreement with an effective interest rate of 12.5% for the year ended December 31, 2025, as mentioned on page 94, suggests that interest expenses have likely increased. Overall, both debt level and interest expenses have changed significantly in 2025 compared to previous years, indicating a notable shift in the company's financial situation. The financial performance of the company has shown mixed results across different years. In terms of revenue from external customers, there was a significant increase in 2025, reaching $9,684 compared to 2023's $6,225. However, this growth was not sustained in 2024, where revenues decreased slightly to $3,925. On the other hand, the company's net loss has worsened over time. In 2025, the net loss reached -$250,639, a significant increase from the previous years of -$126,235 in 2024 and -$95,904 in 2023. This indicates that despite the revenue growth in 2025, the company's financial performance remains a concern. Precigen's management is optimistic about the company's future outlook, citing several key factors that will drive revenue growth. A major priority is the successful commercialization of Papzimeos, which they believe will be a significant contributor to future revenues. To support this goal, the company is investing heavily in research and development programs, with a focus on expanding manufacturing capabilities. Building commercial operations at speed and scale is also crucial for Precigen's success. Management recognizes that adequate third-party coverage and reimbursement for Papzimeos are essential for revenue growth. To achieve these objectives, the company plans to finance its cash needs through a variety of means, including debt, royalty financings, equity offerings, government funding, strategic alliances, asset sales, and licensing arrangements. While Precigen's management acknowledges that generating positive operating cash flows will take time, they are confident in their ability to achieve this goal. In the short term, the company will rely on external financing sources to support its growth plans. Overall, Precigen's management is committed to executing a comprehensive strategy that balances investment in research and development with commercialization efforts and strategic partnerships. The company's financial transactions over the years have been marked by a few notable acquisitions and divestitures. In terms of acquisitions, there is no explicit mention of any significant deals after page 73. However, it is mentioned that mergers and acquisitions are referenced in the context of amortization of patents and related technologies on page 73. On the other hand, the company has made a few notable divestitures. One such example is the sale of its Trans-Ova subsidiary in 2022, as mentioned on page 102. This transaction highlights the company's strategic decision to exit certain business segments and focus on core operations. The company's stance on dividend payments is clear and consistent across various sources. According to page 65 of the extracted summaries, the company has never declared or paid cash dividends on its capital stock and does not anticipate paying cash dividends in the future. This position is reinforced by pages 66 and 69, which confirm that no relevant information was found regarding dividend payments and that the company has indeed not paid dividends. As a result, it can be concluded with certainty that the company has not paid dividends. Concerns about inventory buildup and supply chain disruption are evident in the extracted summaries. Inventory buildup is a concern, particularly with regards to pre-launch inventories valued at $85 million, page 73. This suggests that there may be an overstocking of products before they even hit the market. Supply chain disruption is also a significant concern. The reliance on third-party manufacturers and distributors poses risks, as seen in page 5, where potential supply chain disruptions or inventory buildup are mentioned due to this dependence. Additionally, concerns about timely availability of product and management of shelf life, page 44, further highlight the vulnerability of the supply chain. The dependence on third parties for manufacture and distribution may lead to delays or disruptions if they fail to perform as agreed, page 45. Furthermore, possible supply chain/distribution challenges are noted in page 47. These concerns underscore the potential risks associated with inventory buildup and supply chain disruption. That concludes the financial summary for Precigen Inc. Feel free to comment below, and I will be happy to answer them when possible.